please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Get back to talking about numbers then. We have PNB Housing, which actually reported what was a steady set of numbers. We had the NII, which was up 36% on a year-on-year basis, and the profit was up 44% this time round as well. Asset quality was largely maintained, so 0.3% is where the gross NPA came versus 0.25 and net NPA at 0.25%. So the loan growth also remained robust for PNB Housing Finance, but it has come at the cost of declining yields. To talk more about this, we have the management of the company, Mr. Gupta, the MD, joining in to discuss this. Mr. Gupta, thanks very much for joining in. Well, the loan growth has remained robust, but what is the kind of growth rate that is expected to continue for the company?
As we keep saying that our trajectory for growth rate is linked to the macroeconomic indicators in the industry. And we have built capacities to at least do about 1.7 to 1.75 times of the industry averages. So it is linked to how the industry or the macro market indicators span out in the new year. And the demand is strong. It's a pent-up demand. And I think it's a time when new launches are coming. We are seeing them in parts of the country. And I think a healthy demand will be maintained over the next 12 months.
Okay. Mr. Gupta, you know, your net interest margin, in fact, however, was the lowest ever owing to a decline that we've seen in yields this quarter. How do you see this panning out?
I would not say that NIMs are the lowest. The thing is the combination of products and the segments. We heavily, our portfolio is 80% retail and only 20% is wholesale. And that is why we are conservative players, and it does get reflected in our portfolio quality, where the gross NPAs are only 0.33%. And if you take it at an AUM level, they come down to 0.31%. And we are very confident that we can pass the, I would say, the rising interest rate to our customers. We have already done a reference rate change of 25 basis points across all segments and all products, and our customers have responded well. So I think we can maintain a spread between anywhere between 200 bips to 210 basis points. Our NIMs will be in the vicinity of about 305 to about 310, and our gross margins should be in the vicinity of about 340 bips. And that should be safe for us to give a decent profitability on the portfolio that we are building.
You know, 30% of your books is essentially non-home loans. Almost 60% caters to the non-salaried segment. And despite this, yields have been under pressure. Can you explain that?
The yields are also linked to the cost of funds. And if you see, the cost of funds in the last full year have come down dramatically, much faster, I would say, than the yields. And I can give you those figures for the entire year. They are with me. So if you were to say, you know, how did the yields and the spreads work out, then if you were to say the yields came down from 1076 basis points of 17 to 1007 in 18, but the cost of borrowings came down from 855 to 771, and hence our spread for the year went up from 221 basis points to 236 basis points. And the yields moved up from the NIM moved up from 2.97% to 307%. So there has been an improvement in the spreads and in the NIMs over the last year.
But your yields have fallen from Q4 of 17 to Q4 of 18, which has compressed NIMs in the same period.
It's an annuity product, and the best way to see it is on an annual basis and not on a quarterly basis. There would be quarterly aberrations, but annually speaking, we will be very constant. Our strategies are not changing, and we are very sustainable in what we have designed to continue to do in the market.
Okay. What is your view, Mr. Gupta, when it comes to geographic expansion as well as on operating efficiency?
We have in the last year, the year gone by 17-18, added 21 branches in 7 new locations. This year in 18-19, we are going to add 24 new branches in 9 locations and also add 4 more underwriting hubs. So I think we are going to reach out to a far larger customer segment and the customer base across tier 2, tier 3 cities. We are already there in metropolitan cities. The first 10, we are very much there. And our growths should be healthier than the industry averages.
Okay, well, that's on growth. You've increased securitization to aid your net interest margins. How far would you be comfortable to securitize your book?
So what we plan to do, strategically speaking, is to have a securitized pool of about 8 to 10% of the AUM, asset under management. And that is exactly what we have done in the last quarter also. And that is why, I'm very confident that our cost to income ratios and our OPEX will improve, because we will be having a lot more of fee income through the servicing arrangements on the portfolio that we will be securitizing.
Could you talk about the sharp fall in the gross NPA? Did you sell down non-performing loans in the quarter?
We have not sold down a single loan which is an NPA loan. We have not visited the ARCs in our history ever. And yes, what happens is that the SARFAESI Act is so designed that if you follow the process in true earnest, it takes about 6 months wing to wing to cure an account. And that is why always, the NPAs, so that, we start off our actions in April itself, and the first decline comes in September and the second decline comes in March. So there is no, I would say, unusual, resolution. It's a business as usual. And recoveries is as much a part of lending as it is, is one of the functions of a lending institution. It is nothing unusual.